Bobby has some great information for us today. Bobby's one of the founders of AgriLegacy, along with Wes Hinges and myself, Galen Doty. And Bobby has a CPA firm that he works all through the central part of Missouri and specializes with agriculture and has done a great job in that area. Bobby, thank you for joining us today. I know you specialize with agriculture. We'll just let you get started here, and if you have points that you want to ask any questions or want us to comment, or if we can just pipe in at any time, we'll do that.
Thank you, Galen. I appreciate the opportunity to be here today, and I think we're here in the getting close to the middle part of 2014, and a lot has happened in the estate and income tax area in the last couple of years, specifically since the Affordable Care Act came about in March of 2010. We knew some changes were coming, and there have been a lot of changes since then. And what I'm going to do today is talk about Form 706, portability and basis, and how there is a unique opportunity in 2014. We're going to go through some basic things here, and what we're going to do is attempt to tie together some of these changes that have happened and try to show you how the landscape really has shifted in estate planning. And we're seeing some people fall into the trap of thinking that the exemption amount is so high that they don't need to do anything, and that's really as far from the truth as you can get. So the topics we're going to talk to try to tie that together and to show you why you need to pay attention to the landscape in estate planning and income tax. So we're going to talk about what a gross estate is, what the exemption amount is. We're going to talk about lifetime gifts, the estate tax rates, the unused exemption, the second spouse to die. We're going to talk about Section 1014 basis. We're going to throw in capital gains tax rates and regular tax rates. And we're going to wrap up with Form 706 and what 2014 means as far as having a one-time opportunity to make some changes. So with that, we'll get going. There's a lot to cover, a lot of slides. If anyone has questions, just let me know. Be glad to answer them. And at the end, there will be a time for questions and answers. So if you would rather jot down your question and ask it at the end, there will be time for that too. Okay, very basically, the gross estate of a person. As of the date a person dies, that person's gross estate is calculated, and it's the fair market value of assets owned, which can carry a lot of nuances, minus debt, minus deductible expenses, and that equals the gross estate. Now, as you notice here on the screen, there's an asterisk as of the date of the person's death. Actually, alternate valuation can be done 6 months after the date of death if the estate elects to do so. So actually, the gross estate can be valued as of the date of the person's death or 6 months later. Now, once you figure that gross estate, a lot of times you hear people talk about, especially in the planning arena, inclusion in the gross estate. That's a term that we hear, and that means the asset is considered owned by the decedent, the person that died, and is part of the gross estate calculation. So including something in gross estate could be good, it could be bad, as we'll see in the rest of the program. Now, from the gross estate, an exemption amount is subtracted prior to the calculation of the estate tax. And that's what's been in the news, is the change in the exemption amount. Here's a screen that will show you the recent history of the estate tax exemption, or the lifetime exemption. As you can see, in 1997, it was $600,000 exemption. And over time, that has grown to where in 2014, it's $5,340,000. Now, prior to 1997, it was, I believe, 1977 that the $600,000 exemption was put into place. So for 21 years, that amount didn't change, even though inflation kept going and the value of the dollar changed. What we saw in the late 90s was that more and more people were subject to estate tax. And as you can see on the screen, the rate was 55%, the top rate. And the top rate today is 40%, and we'll talk more about that later. Before we move on, this right-hand column, year 2010, that's kind of the milestone in the estate area. That year, the old laws expired, and as you can see, there are two choices there. The exemption was $5 million or zero, and the rate was 35% or zero. So a person had a choice there whether to have an exemption or not, and after 2010, the exemption has been quite a bit higher. I believe someone's put us on hold or something. I can hear on hold music.
I don't know what's going on there. There we go. There we go.
Okay, thank you.
Sorry, Bobby. Sorry
now,
for that.
From that exemption amount, you have to consider the lifetime gifts that are made. And a lifetime gift is a gift from a person in excess of the annual exclusion to another person, which is reportable on Form 709 U.S. gift tax return. And what this means is anything over the annual exclusion, which is $14,000 per donee for 2014, is considered a lifetime gift. So for example, if a person would give another person $24,000 in 2014, that would be $10,000 in excess of the annual exclusion, and that $10,000 would then be subtracted from the exemption amount that that person has for their estate. Here's Form 709. I've made a screenshot of it. If a person gives more than the annual exclusion amount to one donee or more than one donees, the Form 709 is due by April 15th of the following year, and it tracks the lifetime gifts. So I just wanted you to see a screenshot of what a 709 looks like. That's just the first part of page 1, and there are 5 pages to the return. Now, the key, yes, Galen?
Hey, Bobby, this is Wes here. Just to reiterate, when you're talking about the annual gifts, we're talking about the lifetime gifts. We're talking about it could be cash, but it could be if somebody gives maybe a vehicle or a painting, or it could be anything. Is that correct?
That's correct. It could be property or money, and of course, if it's money, the value is easily determinable. And if it's property, then you have to go through steps to value that property or that interest in property.
Thank you.
Now, I kind of got ahead of myself on that last screen, but the 709 tracks the lifetime gifts, and there's the cumulative reportable gifts, which means reportable on 709, that are made are referred to as lifetime gifts, and they reduce the exemption amount that's available in an estate. Now here's the third page of Form 709, and Schedule B of the Form 709 tracks gifts from prior periods. So this is a permanent record for someone's estate. It tracks the amount of the exemption that's been used for that person's lifetime. So one of the first things you should do in planning is find out if anyone's made any taxable gifts in the past, and get a hold of that that most recent Form 709. Now, we need to talk about the estate tax rates. This is the same screenshot that we had a few screens back when we were talking about the exemption amount and how it's grown from $600,000 to $5,340,000. Notice that the rate was top rate was 55% in 1997. Stayed that way until 2002 when it dropped to 50%. And then it was it dropped 1% per year for several years until 2007, and then it leveled off at 45%. And then in 2011 it was 35% for a couple of years, 2011 and 2012, and for the last year and a half, the top rate's been 40%. So keep that in mind. I want you to have the perspective of rates used to be 55%, now they're 40% on an estate, and the exemption used to be $600,000, and now it's $5.3 million plus. And that number, that $5 million number from 2011, is indexed for inflation. So we should see that exemption continue to rise on an annual basis. Here's a sample calculation of how the estate tax rates would work. If a person died and had $200,000 in cash, there were $1 million in life insurance proceeds collected on that person's death by the estate or the heirs, $2 million in investments, $850,000 in grain inventory, $1.2 million in machinery, vehicles, personal residence of $350,000, and 2,400 acres at $5,500 per acre, which is very common anymore. That makes the gross estate almost $19 million, $18,800,000. And the exemption that's in place for 2014 of $5,340,000 would reduce the taxable estate to $13,460,000. Now this is a simple example. There would be deductions allowed for charitable contributions, bequests out of the estate, for certain expenses, including funeral expenses, and if there were any debt in place, which in this scenario there probably wouldn't be with that much cash and investments, but the debt would come off too. Now that $13,460,000, the tax on the first million would be $345,800. The rate actually goes from 18% on the first 10,000 on up to the 40% on anything over $1 million. So that, rather than list out all of the brackets in that first million, I just lumped the $345,800 as a total, and then the tax on the remaining $12,460,000 would be at 40%, making the total estate tax $5,330,000 roughly. And I did the math on that. That's about 39.6%. So that rate on the first million helps a little, but not very much. It's pretty well a flat 40%. Now, I want to talk about the unused exemption, and that's commonly referred to as, we call it DSUE. That's in the tax arena, that's what it's commonly referred to, DSUEA. And that stands for Deceased Spouse Unused Exemption Amount. The estates of decedents who die after December 31st, 2010 may elect to transfer any unused exemption to the surviving spouse. This is referred to as portability of the unused exemption. And that's what's been in the news, is portability. It means that if the first spouse to die doesn't use all their exemption, the surviving spouse can get the unused amount. But it's not as simple as getting it. There are some steps to take to get that portability.
Hey, Bobby.
Yes.
One question that comes to mind when you say that is, for example, you're going all the way back to 2010. That means if someone lost a spouse during that year, that if right up to this year they can go ahead and use portability. Is there a time frame when you lose that? You may be addressing that very soon.
There's no time frame to lose the portability once you get it. The only thing that can cause a surviving spouse to lose portability after it's been elected and obtained is if they remarry, and their new spouse dies. And we'll get to a screen on that. But the key is you have to get that portability before you can have it to either use or lose. And we'll catch that, Galen, here in just a little while.
Thank you.
Here's a simple example of how the unused exemption might work. I'll just read through it. Homer and Mabel are married, and Mabel passes away in 2014. Actually, that needs to say Homer passes away in 2014. Homer's estate is valued at $3,700,000. Since Homer's estate plan passes his entire estate to his wife Mabel, the federal estate tax would be zero due to the unlimited marital deduction. His taxable estate is zero because everything was left to his wife. That's how his plan was set up in my example. And since his estate didn't use any of his federal estate tax exemption, which was $5,340,000 because he died in 2014, the exemption is wasted. However, under these new portability provisions, homeowner's estate can elect to pass that unused exemption to Mabel. How is portability claimed? You claim it by filing a federal Form 706 and making the portability election on homeowner's estate tax return. The Form 706 is the U.S. estate tax return. If this portability election is made on homeowner's estate tax return, his unused exemption of $5,340,000 is transferred to Mabel and increases her future estate tax exemption by this unused amount. And here again, this unused amount is referred to as the deceased spouse unused exemption amount, or DSUE. And you note you have to timely file a federal Form 706 in order to claim portability. Now, on the second spouse to die, when that surviving spouse dies, which would be Mabel, her gross estate is calculated and the exemption amount is increased by the DSUE prior to calculating the estate tax. So what happens is Mabel gets her exemption that's in effect in the year of her death, which might be more than $5,340,000, plus she gets the DSUE from Homer. And at the bottom of the screen, you can see that we mentioned a few minutes ago, only the DSUE from the most recent spouse to die may be used. So once you've obtained DSUE as a person, the only way you can actually lose it is if you remarry and the second spouse dies, and then you'll get a new DSUE from that spouse, if there is any. If that spouse does not. It has some interesting planning connotations there. Before you get married, you need to know what their DSUE might be. Now, I want to go ahead and talk about Section 1014 basis. It may seem like we're jumping around here, but all this ties together as we go on through the presentation. Basis, what is it? How do you get it? And what do you do with it? Basis is not a factor in determining estate tax. We need to make that statement. Fair market value is used to determine the gross estate, not basis. Basis has no bearing upon how much estate tax is due or how much of the exemption is used. How do you get basis? Typically by purchasing an asset, such as a tract of land, and that's referred to as cost basis. It could be a combine or a tractor. The purchase price would be the cost basis. You also get basis by inheriting an asset, and that's referred to as Section 1014 basis. Sometimes people will refer to that basis from inheriting an asset as stepped-up basis, but that's assuming that the value is higher than the cost. If the value of that asset when it's inherited is lower than the cost, you actually get a stepped-down basis to the fair market value. So actually, the Section 1014 basis should be referred to as fair market value basis or Section 1014 basis. Another term that's used in basis is adjusted basis. An adjusted basis is the amount that you can deduct when selling an asset to determine your taxable gain. Basis becomes adjusted through taking depreciation deductions. The amount of depreciation expense claimed and deducted on income tax returns reduces the original basis of an asset. Therefore, you get the term adjusted basis. For example, if you purchased a combine for $350,000, typically that's a 7-year depreciation deduction. So after 7 years, the basis of that combine may be 0 instead of $350,000. And that would be the adjusted basis, would be 0. Now, how do you get the Section 1014 basis? You get it by inheriting an asset that has been included in the gross estate of another person. So basically, it has nothing to do with filing or being required to pay estate tax or anything like that. It's just by the fact that you have inherited an asset from someone else, you get the fair market value as your basis, and that's called your Section 1014 basis. How much is it? It's equal to the fair market value of the asset that is inherited. And it's the same value that's used in computing the gross estate, and that's used for your Section 1014 basis for that asset. So the things have to match up. If a tract of land is included in an estate at $5,500 an acre, then that becomes the basis in the hands of the heir for that land. You can't put it on the estate tax return at $5,500 an acre and then have a different basis in the hands of the heir. Now, what you do with basis, including Section 1014 basis, is you depreciate it to save income taxes or deduct it to lower gain upon the sale of an asset, which lowers capital gains tax and or your regular income tax due. So basis is good to have. You want to establish basis because it will save you income tax or capital gains tax. And if you think about it, a person would like to have the highest basis possible in an asset. Higher is better than lower when you're talking about basis. Now, we're going to start to tie estate tax and income tax together here. Here's a history of the top federal income tax rates. 1913, that's when the federal income tax was started, so we're in about the 102nd year of it, 7%. Didn't take long until it went to 67%. And then, as you can see, during the Depression and World War II, the top rates got really high, 94% in 1944. We think our rates are high today. That's way higher. Then as the war ended and the Cold War ended, rates started coming down. In the 80s was really when we became spoiled with low rates. By 1988, the top federal rate was 28% for income tax. And then we saw a little bit of an increase in the 1990s, followed by, with the economic issues that hit our country in the early 2000s, the rate was cut to 35%. And however, last year, 2013, we went back to the 1993 rate of 39.6 with a little variation. You see the asterisk there. What that asterisk indicates is that there's a new Medicare tax rate of 3.8% on net investment income that applies beginning in 2013. It's called the Net Investment Income Tax, or the NIIT. It was a part of the Affordable Care Act in March of 2010. It didn't kick in until 2013. It falls under Section 1411 of the Internal Revenue Code. We commonly call it Section 1411 tax, or the net investment income tax. It starts when adjusted gross income exceeds $250,000 for married filing joint or $200,000 for single. So relatively quickly, that tax applies, and it applies to trusts when the trust top income tax rate is reached, which is $12,150 of taxable income in 2014. So a trust can pay this 3.8% tax on investment income very, very quickly. The capital gains tax rates have also been increased recently. Here's a recent history on those rates from July 1998 to 2000. The rate was from 10 to 20% on capital gains. From 2001 to May 2003, it was from 8 to 20%. The 8% came in whenever you had held an asset 5 years or longer, which no longer applies. May of 2003 through 2007, the rate dropped to 5% through 15%, and then a scheduled increase from back in 2003 kicked in 2008. It decreased, not increase. The capital gain rate was 0 as long as you were in the 15% regular rate or lower on your tax return. And for 2013, that 0% rate became permanent, which was somewhat unexpected that it would become permanent. But at the same time, the 15% top rate was increased to 20. So now we have a rate that's either 0, 15, or 20 for federal capital gain taxes. The 20% starts when a person gets in the top tax bracket, which for 2014 is $457,600 of AGI if you're married filing joint, is $406,750 if you're single. Capital gain rates also apply to qualified dividends now. So if you have a dividend paying stock, you'll pay the capital gain rate on that. If you want to put these rates in perspective then, the top tax rate is 39.6% plus 3.8% net investment income tax, 43.4% combined rate, plus 6% state tax if you're in Missouri. Some states are higher than that. Some states do not have income tax. We are seeing some advice from estate planning commentators about choosing where you live when you die. And if you pick the right state, you may not have as much estate tax or income tax, because some states have estate tax or inheritance taxes and some don't. That's beyond the scope of today's presentation. But if you can do the math, the top tax rate with the net investment income tax plus 6% state is 49.4%, almost 50%. And we're talking about income tax rates. Very high compared to recent history. So I have 3 questions to ponder. Question 1, which tax applies to more people? The income tax, capital gain taxes, or the estate taxes? Well, by far, the income tax and capital gain taxes apply to more people because they apply to everyone that files a tax return on an annual basis. Estate taxes only apply to someone that's died and to someone that has an estate valued more than the exemption amount, including whatever dissui they may have. So by a far vast majority, income tax and capital gain taxes apply to more people. Which tax rates have increased in recent years? Income tax and capital gain taxes or estate taxes? Well, as we just saw, the income tax rates and capital gain tax rates have increased in recent history in our country. Which tax rates have decreased in recent years? Well, the estate tax rate has decreased in recent years. If you remember, up until 1997, it was 55% for the top rate, and now it's 40%. Now, we're going to work towards having a look at what you can do in 2014 that may help tie some of these concepts together. Here's a Form 706 screenshot, United States estate tax return. That's just page 1, the top of page 1 of 31 pages. And most of those returns require attachments too, so they're longer than 31 pages. Form 706 is due within 9 months after the date of death. If there's any tax due, that is also due 9 months after date of death. It lists the asset values, calculates the gross estate, shows the exemption amount, dissui, etc. It's also used to transfer the unused exemption to the surviving spouse of the person that dies. So, Galen, you or Wes one had asked, how do you get that? Is there something you have to do? Absolutely. In order to transfer your unused exemption amount to a surviving spouse, you have to file Form 706 on a timely basis. Now, 2014, there's a unique opportunity. Revenue procedure. Yes, you have a question.
I'm interrupting you. Yeah, on the, I wanted to clarify again, because you had stated earlier that all the way dating back to 2010, that anyone who'd lost a spouse, don't they can still do that, right? But you're right, they only have 9 months to do it from this year.
That's correct. And actually what's happened there, Galen, is for anyone that died in 2011, 12, or 13, it's pretty well too late to file a timely 706. And if they didn't do it, the surviving spouse doesn't have the unused exemption amount. They don't have the DSUI. Now, if someone died prior to 2011, portability wasn't available, and there was no option to get the DSUI. So what's happened in 2014 that can allow a person to claim this unused exemption amount is IRS issued Revenue Procedure 2014-18 on January 30th of this year, and it provides relief from not filing a timely 706. It allows a portability election to be made, and it's available through the end of this year, December 31st, 2014. So RevProc 2014-18 can be used for the remainder of this year, and in order to use it, there are certain requirements have to be met. The decedent, the person that died, has to have had a surviving spouse. Otherwise, there's no one to transfer the DSUI to, the unused exemption. The person had to have died after December 31st, 2010, and on or before December 31st, 2013. And they had to have been a U.S. citizen. Now, 1B there, we need to be sure we're clear on that. If someone died in 2014, a timely 706 needs to be filed 9 months after date of death. So conceivably, if someone died January 1st of 2014, the estate tax return is due in 9 months, which would be October 1st of 2014. And RevProc 2014-18 would not be available for that person. So what's available is someone that died in 2011, 12, or 13 that didn't claim the unused exemption, didn't transfer it to their surviving spouse. We can still do that for this year. Another requirement that has to be met in order to use the RevProc 2014-18 is that the decedent was not required to file an estate tax return based on the value of the gross estate. So this is really, RevProc has came about to allow people that didn't think they needed to file because there was no estate tax due, but were unaware that you really needed to file to get this portability of the unused exemption. If a person was required to file, an estate was required to file an estate tax return because the values were more than the exemption amount, and they didn't, now they have just kind of blown it because they should have filed for other reasons, and the IRS is not allowing them to get relief from missing the portability election. Also, the estate cannot have already filed an estate tax return within the prescribed time for filing. So if the estate has already filed and didn't elect portability, they can't go back and elect it. Filing the return and not electing the portability is, in fact, electing out of it, which I can't imagine why anyone would want to elect out of the portability. It would have had to have been that the estate was unaware of what was going on, that portability could be claimed. And also another requirement, which we've mentioned, is a properly prepared Form 706 must be filed on or before December 31st, 2014 to elect portability of the unused exemption amount. Now there is a somewhat streamlined procedure available for filing the 706 just to get portability. So values can be estimated and rounded. If the information is just not available, an estate may want to do that. If in most cases it's better to actually get appraisals and valuations done and file an exact, accurate 706. But there is a provision included in this RevProc to use estimated values. And in fact, outside of this RevProc, going forward, if an estate wants to get the portability but otherwise would not be required to file, that estate can also use some estimated values if necessary. So I wanted to leave a little time for questions and answers. We've got about 10 minutes, but where do you go next in this situation? If you have an estate or a family member that maybe hasn't done the election for portability, obviously you need to get them in front of a professional soon because this opportunity will be gone in about 7 months. But I think even more than that, in addition to that, to go a little deeper, in order to do effective estate planning now, if you think about it, the estate tax rates have went down. We have a substantially increased exemption available now. We have portability available now for the unused exemption amount, which kind of takes the pressure off of estate tax. Rates are lower, exemptions are higher, you get to double up with your spouse. If you do everything right, you got a big break on estate tax. But if you think about it in the same planning situation, income tax rates are much higher. Capital gain rates are higher. We have new taxes, the net investment income tax. We have increased federal tax rates. And we talked about getting basis. And we talked about how getting the highest basis helps you on income tax and capital gain taxes. Doesn't really help you on estate taxes. But if income tax and capital gain tax applies to you, every year somehow, as you file your tax return, if you can inherit assets at the highest possible value without costing any estate tax, you certainly want to do that. So depending on how things will go in your operation with your family, you need to have some idea of, will assets be sold after your death? Will they be held by the next generation and not sold? Of course, immediately you think depreciation, which can save the next generation huge amounts of income tax by depreciating the farm buildings, the combine, the tractor, the breeding stock, etc. You need to consider which is more important in your situation. Do you need to preserve basis to avoid those high tax rates? Do you need to reduce estate tax that would be due at your death? Do you need to work out a structure in your plan that would balance the two? You don't want to obviously cost your next generation estate tax if you don't have to. If you think about our example in an $18.8 million estate, the tax was roughly $5.5 million for estate tax. If you remember in my example, there was $200,000 of cash, $1 million of life insurance, $850,000 of grain. And you're looking at a little over $2 million of liquid assets, and there was $13 million in real estate. How is that estate going to pay the estate tax if it's $5.5 million? It's going to use all of its liquid assets, and then it's going to tap into real estate. In that situation, you could jeopardize the continuance of that operation because of liquidity problems. So you don't want to cost estate tax by trying to get too much basis later, by including things in the estate later. You may want to freeze the values now. You may want to use that exemption up now and forego that higher appreciation in the hands of the next generation. So these topics need to be discussed with your family, with professional counsel, to balance out income tax, state tax, and basis. Now the next steps, obviously we here at AgriLegacy have some systems set up. You can view this later online. I don't expect you to see it all now, but it's available on our website. We do have tax management solutions in place for you. We can review your situation and put some of the latest strategies in place to help you. And also, we have some estate planning solutions and packages that will help an operation and a family keep things going for the next generation in a tax-efficient and family-friendly manner. There are some complimentary appointments available, reviewing documents to get started. At this time, we could take questions if anyone has questions about the presentation or something else.
Hey, Bobby, that was really a great job and very interesting. One of the things that I think is important, and I don't think anyone wants to miss this who might be listening to the call, and that is that portability, even though someone might be under that $10 million exclusion amounts between two spouses. Portability, still, even if you have to use portability, because if you do the trust work in advance, it's a little beneficial, right? One of the benefits is that you can protect the assets, and then if there's a death of a spouse, a death of one spouse, then that appreciation is also still carries the GST, the asset protection, and is sheltered from taxes. But if you did not do the trust work ahead and you have to depend on portability, so you're using portability to try to protect as much as possible. If there's appreciation, then we're creating some additional estate taxes. Am I right on that?
You could be. If there's appreciation in the assets from the date of the death of the first spouse until the date of death of the second spouse, you could be at risk for additional estate tax if everything fell into the hands of the surviving spouse. Some of that risk could be, and Galen, if the surviving spouse lives a long, long time, if the assets are appreciating rapidly, like farmland has recently. And also we're at risk for the political environment. We don't know that even though the exemption amount is permanently at $5 million indexed for inflation, that only means until the next Congress votes to change it. And that can be scaled back. Gifting, the gifting amount, lifetime gifting amount is connected, or it's coupled, unified with this exemption amount now. That hasn't always been the case. So certainly, Galen, there are other factors at play, and depending on what the situation is, you may want to have trusts in place to protect the assets and to freeze the value that's subject to estate tax.
Bobby, this is Wes. I'd like to ask you about some documentation on basis. What needs to happen? What type of documentation do we need to have in place in order to get basis at a death?
It depends on the type of the asset. Of course, if it's cash, a simple bank statement, CD document would be sufficient. If it's grain, you look at the local market and the quantity on hand. If it's machinery or livestock, you have to get an expert in that industry to appraise the property for you, to tell you what it's worth. If it's real estate, you need a qualified appraiser to appraise the real estate. So and then you need to keep those documents, the appraisals and the statements and the information from the equipment dealer that tells you what the prices are for equipment, things like that need to be kept as permanent records.
Well, one last thing I wanted to kind of throw in there, and that is, again, dating back, because they proactively allowed us to go back in time, right, and preserve, if someone had not done good planning, trust work and that type of thing, they do allow us to go back and help those who were over $5 million, right, and with the portability. So it is a big issue.
It is, and
it's
a matter of timing too, Galen, because this RevProc came out in January, and it would almost be unheard of for the IRS to come back and say, oh, we're going to give you more time. It's going to end December 31st of 2014, and for the people that have missed out on the portability election, for anyone that died in 2011, 12, or 13, you're not going to be able to make it later. And for people that died after 2013, it's 9 months. Now, you can get an extension on your gift tax, on your estate tax return of 6 months. So it's possible to actually get more than 9 months. You can get to 15 months. But outside of that, if you haven't filed and claimed portability, it's going to be lost.
Bobby, thank you so much for your information and presenting this webinar. A lot of good facts and information that everyone needs to know. We will be looking forward to some webinars in the future, and we'll make sure that that those on the call, as well as those who could not make this call, are aware of it. This will also be recorded, and so if anyone wants to pick this up later, maybe they couldn't make the call today because of timing and whatever, but we would just appreciate your comments or questions that you might have for Bobby in the future. You can always contact him at his place of business at 877-247-4534 and contact AgriLegacy with additional questions. We appreciate your listening to the call and look forward to hearing